Hi, what I'd like to do now is to start to talk to you, introduce the topic of financial instruments, and this has probably been one of the most problematic issues in financial reporting over the last 40 to 50 years. So, what are financial instruments? The most obvious financial instruments are what we might generally refer to as financial assets and financial liabilities, and these might be thought of as including fixed interest securities. There's nothing contentious there. But where financial instruments become much more problematic is where we see that they include derivatives, and these derivatives are going to be instruments such as swaps, options, futures, forward rate agreements, and the list goes on. And it's these derivatives that have been the most problematic. We can see the growth in the magnitude of derivatives if we look at this report here, or an extract from a Bank of International Settlement report here, which shows the gross value of derivatives traded on the global over-the-counter derivatives markets. And at the end of 2019, the market value of the derivatives was $11,500 billion US. That's a significant amount. But just to give you an appreciation of how much more problematic the topic is, the value of assets which underlie those derivatives at the end of 2019 was $558,000 billion US. And that should tell you two things. One, there's a lot of them, and two, there's an awful lot of leverage inside the financial instruments, these derivatives, and that means that there's going to be an awful lot of volatility in price. The significance of derivatives is also captured here in the balance sheet for Deutsche Bank, and we can see that at the 31st of December 2019 they had financial instruments, financial assets at fair value through the profit or loss of 530,000 million euros, and this represented approximately 40% of their total assets of almost 1.3 million euros. Derivatives have also been central to a number of financial crises or financial scandals over many years now. One of the early scandals involved Sumitomo Bank and a guy called Hamanaka who traded in copper derivatives, and he was quite successful in manipulating the copper market for a number of years before he finally got caught out, and the losses to Sumitomo Bank ended up in the vicinity of $2 billion US. You can move across to the United States, and Orange County went into bankruptcy thanks to a guy called Robert Citron, and his speciality was interest rate derivatives, and I think he went for around about $1.2 billion US in losses. Nick Leeson, of course, took down the Barings Bank, and he made losses of about £600 million. He was basically on foreign currency derivatives. And a similar story arose with a guy called Andrew Covell in Australia and a company called AWA. In Australia we also have Luke Duffy, who went for about $400 million at NAB on foreign currency derivatives. And derivatives were also central to the global financial crisis, which occurred just over 10 years ago now. I know that many of you have probably never heard of a company called Countrywide Finance Corporation, but whilst it isn't a household name, what you would need to understand is that at the beginning of the financial crisis, it was the largest originator of household mortgages in the United States. I know you'd have heard of companies like Bank America, Wells Fargo, Citigroup, but no, Countrywide Finance sold more household mortgages than any of those. And the way its business model was basically originating the mortgages, packaging them up, and then selling them as collateralized debt obligations. That's the GFC. Also during the GFC you had Lehman Brothers, who were also involved in transactions involving financial instruments. These transactions were classified as Repo 105 transactions. So it's fair to say that financial instruments are very, very significant, and they've been associated with some very, very significant financial scandals. That makes accounting for them particularly problematic. If we look at the framework, there's probably nothing in the framework which would distinguish financial assets and financial liabilities in terms of the definitions of assets and liabilities. Where, however, the accounting for financial instruments becomes more problematic is in relation to recognition. And this is a problematic because in the case of derivatives, it's sometimes not obvious what the underlying asset is, and measurement. And this is a problem due to the extreme volatility in the derivative share prices. So measurement is going to be a challenge. If we think about the accounting choices that exist in relation to accounting financial instruments, we can see that these are just assets and liabilities, and the choices are essentially the same. One approach would be to adopt an historic cost approach, and if we adopt an historic cost approach, we'd record the asset or the liability at the time of initial recognition. The price would be fixed, and we could use a method for accounting it progressively or subsequent to initial recognition, and this might be labelled the effective interest method or amortised cost. If we think about this in relation to a single cash flow financial instrument, say an option, what it's going to be saying is that if we purchase an option to buy US dollars at an Aussie dollar US dollar exchange rate of 76 cents for $10,000, at inception we'd recognise it at $10,000, but the question is, what is it worth today? It's going to change. It'll change regularly, but under an historic cost approach we'd leave it at that $10,000 until the option expired. If we think about historic cost in terms of a financial instrument with multiple cash flows, let's think about a fixed interest security. And here we have a fixed interest security which has a face value of $1 million. It has a coupon of 10% paid annually and a maturity of 5 years. It's sold at a yield of 8%. So in that particular instance, what an historic cost approach would say we'd work out the fair value at the date of issue, $1,079,000, which is simply the present value of those cash flow streams. And under an historic cost approach, we'd recognise that at a fixed interest rate of 8% over the duration of the financial instrument. What you can see here is this is recognising a constant interest rate, so the interest amount is relatively stable and it doesn't change. And in terms of the accounting, at inception we'd recognise a loan and we'd recognise the cash being received. And then over the life of the bond, we'd recognise the coupon payments, the interest expense, and the change in the value of the bond on an amortised cost basis with the principal and interest being allocated. In year 2, we'd recognise $100,000 worth of cash and the interest expense. Year 3, year 4, and year 5. So that's what an historic cost approach would look like. What about a fair value approach? Under a fair value approach, you'd record the asset or liability initially at fair value, and under fair value you have a variable price, and that dictates that any changes in price would be recognised progressively. So for example, if you had an option, which is an example of a single cash flow financial instrument, if you originally purchased it for $10,000, at inception you'd recognise it at $10,000. If at the end of the financial year it was only worth $2,500, you'd recognise the change in the fair value of the option as a gain or a loss. So in this case the option's gone down in value, so we'd recognise a loss of $7,500. So those are our basic accounting choices for single cash flows, and a similar approach could be adopted for a multiple cash flow entity. So what if we had a fixed interest security? A fixed interest security with a face value of $1 million, a coupon of 10% paid annually, and a maturity of 5 years, is initially sold at a yield of 8%. The market yields at the end of subsequent years are 7.5%, 7.25% and 7.75%. So what we could do is we could work out what the market value of that financial security was over the remainder of over the life of the bond, and we could work out the accounting for that on a fair value basis. And what we could see here is that within the first year we'd recognise the coupon payment, we'd recognise an interest expense, and we'd recognise an increase in the market value of the bond. Year 2 we'd recognise coupon payment again, we'd recognise a interest expense and a reduction in the value of the bond. and we'd repeat that in years 3, 4 and 5. So those are our basic choices. So where to from here? Well, what I'm going to do now is to try and introduce you to, rather than one accounting standard, to multiple accounting standards. IFRS 7, 9, IAS 32 and 39, and the corresponding AASB 7, 9, 132 and 139. And as we do this, I'm going to work you through what the issue is generally and how it's accounted for, the general provisions for financial instruments. And then we're going to focus on separately on financial assets, financial liabilities, recognition, derecognition more properly, derivatives, and finally hedging. So that's how we're going to work through this topic.